Thank you for having me. I'm Marc. I work for the Pyth Data Association. Pretty much you can imagine, it's a Swiss association behind the Pyth network. Pretty much you can imagine Ethereum Foundation to the Ethereum network. And Pyth is a first-party oracle. I'll keep going on myself. I'm based in Porto. It's been a year I'm here. We have an office in NG. We can sit 9 people. So anytime, ping me. We can have lunch. You can work from the office. We're happy to meet people here. And thank you for listening to me. Today we'll see mainly 3 things, many other things to talk about, and I haven't included the ZK part research we do within Pyth. Maybe at the end I can talk about that. But overall I wanted to present the architecture, why we built it this way, what makes Pyth different on the usage case, and further going along the usage case, how can protocol build in a new way with Pyth. So on the architecture, before even starting building it, the whole project came from a TradFi background, very into trading. So we really kind of faced the 3-4 last years of DeFi, where it's kind of the 90s of trading. It goes slow, and you still are very far behind what you see centralized solution, centralized exchange, and TradFi exchange. And the whole idea of further building this tool is really to put DeFi at the same level as TradFi. I think today we see DEXs do 20% of centralized exchange volume, goals to overtake and destroy there. And having and bringing a fast oracle, a low latency oracle, can actually make a better UX and better protocol overall, less fees charged or just greater capital efficiency. So Pyth, you can really imagine it somehow as a data marketplace where you have data contributors, data publisher on one side, and users on the other side. We show the world because it's available both on-chain, 15 different chains, but also off-chain. And on the left side, you have the data publishers. I'll go a bit more on this later, but overall, we have exchanges, market makers, trading firms contributing data to the Pyth oracle. Pyth is like a smart contract. We have our own, it's an application-specific blockchain where we do pure price aggregation. And from there, we're able to send this price on many other blockchains. So this structure, based on this, we really focused on 3 things. First, getting first-party data providers. Second is, with this new design and first-party providers, we're able to introduce new data points, confidence intervals, and still on the let's make this fast, let's make this centralized exchange vibe, is the on-demand model. So all the publishers, Pyth, we have up to 80 today. So overall, they directly contribute data to our blockchain, the price aggregation, the smart contract runs, it aggregates, gives you an output. And this, we have half a second block time. So pretty much we have kind of price feeds updating 300 times per day. And all these publishers directly interact with the smart contract and our blockchain. We have big names all the big exchanges, Binance, Gemini, all the big SEXs. We also have a few DEXs. And on top of that, we also have TradFi exchanges. We have Cboe, IEX, and those are top 5 exchanges in the world, whether options or futures trading. And all this, having this pool of data providers actually give us access to data that before you cannot get access to. For example, today, if you check the Pyth website, you'll see that we have 50 price feeds for US equities, 15 different FX, and all this is really based upon those first-party data providers that either trade or have the order book and can provide this data. We're at 80, down the line, goals to be at hundreds and hundreds and hundreds, and likely we'll go through the ZK way to actually be able to scale that far into both the aggregation and the delivery of the data. We've been around for 2 years, so we've been lagging recently, but at some point we were like one new provider per week. Now, slow down a bit, it's every 2 weeks, but maybe by the end of next year we'll be like in the hundreds. The second thing is confidence interval. So whenever someone, like the overall idea of confidence interval is we came to the realization that there is no single price for an asset. And one Bitcoin today, you can sell it at like on 25 different exchanges, let's say, you'll never get filled at the same price. And it's important to enable applications to factor this. And one of the greatest example of it, and I should have maybe put graph of this, is the Luna UST crash. Like as it went to zero, you had like FTX, you had Luna, or I think, yeah, you had Luna on FTX trading at 5 cents. On OKX, it was 1 cent. Because OKX had halted withdrawals. So it happens to have like big discrepancy in the market. And when this happens, like it's hard to tell you a hard price. Like what's the price of Luna at this time? Like pretty much no clue. So these intervals manage to like capture this uncertainty, but it also has a security purpose. Here we have an example. So here we see like Bitcoin, we give you a price and we'll tell you could be plus minus $10. Usually it's like 1 basis point, the confidence interval. And on the security purpose, we can see on the left, so the bottom 5 lines are individual publishers. The top one is the aggregated price. So those confidence interval also enables to kind of filter out like malicious, voluntarily or not, publisher that would start sending wrong prices. And when you kind of create from this input the price on the right, you'll see that the middle one is the price, and on top of it, we'll build the confidence interval. So with this, you can actually, let's say your borrow lending protocol, you could be your collateral, I'll value it at price minus the confidence interval to be more safe, let's say. But when liquidating, I could be a bit more aggressive and tell you whenever your asset or your borrow like hit the price and confidence, I'll liquidate you, just to ensure like max safety for the protocol. Added another example where you could, where it further help designing where the good price is. So here on the left, you see 2 publishers that are very confident the price is around 100. The 2 others are a bit more fleeky around it. But with our aggregation method and confidence interval, you'd end up with a price and its confidence like representing a good collection of people that agree that the price should be around 100, but you have kind of a leak towards the 100 plus. And if you just go on the website, you'll see all our graphs look like this. So you can imagine the confidence, grossly speaking, as a bid-ask spread. It's not, but you could imagine. Another thing where we really spent a lot of time on is how data gets delivered to the applications and how we can make applications much better or operate much better. Most oracles today work on a push model, so based on set of rules, either time elapsed or price deviation, they update the price on chain for you, let's say, and then your application can read it. This is also kind of an issue that first, you cannot customize it. If you want more frequent updates, you cannot. And also, you rely on someone else doing this job for you. Pyth, we spinned up the Oracle as an on-demand model so that anyone can at any time request any of our 200 price feeds on its chain. We have, from our application-specific blockchain I mentioned before, we have all those prices getting created. From there, we have Wormhole that pretty much observes, reach consensus on what are those prices, and those prices become available through an off-chain API. So application integrate two-way off-chain API and the on-chain Pyth smart contract on their chain. So first step, they go fetch the off-chain price and the proof, bring it into the Pyth smart contract, update the prices in there, and then can fill the user do their action. This enables getting pretty much in like 1 second the latest price of Bitcoin on your chain to do whatever you want. So if you're a perp protocol, someone click trade too long, you go fetch that price, put it on chain, fill your user. And an addition of this is being permissionless. The more users, the more updates you'll get. And at some point, you could even imagine like have free riders that you have so many users, so many requests, so many price updates that you can just read whatever the others do. Alpha. You can read the prices brought by the others. And from our perspective, it's also great to have this permissionless system. First, it's not costly at all. We don't do the job. We don't bring those prices on chain. We don't pay the gas cost. Also enables to be way more scalable. We have 200 price feeds. So all those price feeds are available on all these chains. We don't do segmentation of those feeds go on Ethereum, those on Phantom, those on Starknet. It's like you come, serve yourself and bring it home. And for example, recently, so we started this solution last summer, and since Christmas, it has gotten quite a huge traction, especially on EVMs and perp protocol. Over Christmas, we got Synthetics to integrate with Pyth for their perps v2, and pretty much wanted to show how like it can impact your protocol and your users. So before on Synthetics, V1, they were using a push oracle. So pretty much waiting for the oracle to update the price every 10 minutes, every X% price deviation. And then the user click trade, keeper read this, he submits, user get filled. And with Pyth, and the problem of this is if the oracle price, the push oracle price feed has like, let's say 1% price deviation threshold, it actually means that you have like 2% buffer around the price you're given. If I say like ETH is at 100 plus minus 1%, it could be 101, 99. You have no way to know on chain. So applications, and especially perps, don't want to get arbitraged versus like delayed prices. So they had to have like huge fees just to cover the potential arbitrager going and just trading against the LPs and the stealth oracle. With Pyth, you actually have the like tooling to now, whenever the user click trades, you ask and request the price to get set on chain, and you can fill the user at the exact time he clicked trade. So pretty much you end up with 0 oracle latency when you fill your user. And this is great for the user because what he sees on the UI will get filled at, and great for the protocol because barely no one, if not no one, can just trade against your stealth oracle. And here, but we just showed, for example, like the SEX prices versus Pyth prices made available on it must be Optimism, and like there's pretty much like 0 or very little discrepancy. And in performance, one thing that's pretty cool to see is, especially on the user side, let's say, so V2 on the right will be Pyth, and on the left is the V1, so push oracle. Started since Christmas, already at 1.5, maybe 2 billion tonight. But what you see is the ratio from volume to fees. Here, I think I calculated, you have a lot of digits, but overall you have like 20x less fees applied there. And all this, and it's not so much protocol generated fees. It's like fees borne by users. So this on-demand model, like really enable you to get fees as low as centralized exchanges or even lower. And on the Pyth side, so for example, this is a dashboard of all the prices, like the price updates on Optimism made by Synthetics. And for example, the last few days, and it was like during the USDC JPEG most likely, they were doing about 10,000 price updates per day. And all this paid either by the app or the users. So pretty much Pyth as an oracle cost us nothing to do like 10,000 price updates in a day. So that's very cool for us, so that like first, we don't go to the ground on gas costs, but it also kind of enable any of you, anyone on Optimism, to get those reads for free. Someone's updating on chain for you, and shows that somehow this on-demand, this request model is successful. Told you it was short. It's short. I'll just do the 3 last slides just to show you scalability. It shows 10 at Feb 23. Arguably, we're at 15. But overall, with this on-demand model, scalability, like we've deployed on like 15 blockchain in less than 6 months. So that's like super great for us. That's our goal, be everywhere. And even off-chain, we have off-chain users. Starknet is coming very soon. We're refactoring a bit, maybe a week or 2, a bit of alpha here. But if you're already looking at other ZK, we are on ZK Sync testnet mainnet and Polygon ZK VM, soon TM. And StarkX, of course, after Starknet. And data feeds. So again, as we don't have to send those prices on chain, pay gas, pretty much we can have an unlimited amount of feeds that anyone can use on any blockchain. So, and actually you can spot the 2x is when we introduced this cross-chain version. It was like time to go big. By the end of this year, let's hope to be at 500. We're actually working a lot recently on ETFs. Like I don't know if you know Backed and all, working on Coinbase, like tokenized Coinbase and stuff. So soon, like more crypto as always, but more ETFs, US yield, all this kind of feeds. And here, well, just to show from a Solana native to kind of any chain now, we have like more than 100 apps using us. And I think like over the weekend with USDC depegging, we must have been at like 50K price updates on all chains combined, all paid either by applications or users. And that was the last one. Thanks a lot for listening. I don't know if you have any question. I'll just add one thing. If you have, you'll remember us if you have a bucket hat or a t-shirt, that comes from us, and I hope you like it.
Any questions?
If nobody else has a question, then I will have my own. So this is only one right now. Can it help avoid slippage on Uniswap trades?
Depends on how you integrate. Specific to Uniswap, I have to double check, but we have, for example, it's one Lifinity on Solana and Swap on Polygon. They integrated an Oracle to, they're a bit set up differently than Uniswap. It's like protocol own liquidity. So pretty much they integrated the Oracle within their like price fixing in the AMM so that like they actually trade against their own pool to avoid arbitrage. So rather than relying on you and I doing the arbs, repegging the AMM itself, it's like POL actually, repegs it to the Oracle price. And with this, like you get much less impermanent loss because you don't have the arbitrager taking it for you. It's like the liquidity then paying you back. Specific to Uniswap, I think on the V3, I think it's, and it must exist, I guess, is like protocol that automatically like reset your range depending if 10% up, 10% down. So I guess it's more protocols building on top of Uniswap rather than Uniswap wanting to integrate one directly. Then happy to. Actually, I'll have one question myself. How many of you knew Pyth before or heard about it? All right. Cool. Need more work to do. Okay.
Any
Thanks a
last
lot.
question? Otherwise, that's it. A big round of applause to Marc.
Thank you.